Economic uncertainty can strike unexpectedly, rattling markets, businesses, and individuals alike. Whether triggered by geopolitical tensions, inflation, recessions, or global pandemics, financial instability demands a reassessment of how and where you park your money. During volatile times, protecting your wealth becomes just as important, if not more so, than chasing high returns. To help you navigate through uncertain financial waters, here are the top 10 safest places to store your money when the economy becomes unstable. 1. High-yield savings accounts. High-yield savings accounts offer a perfect balance between safety, liquidity, and modest returns. They are insured by the FDIC up to $250,000 per depositor, per bank, providing a government-backed guarantee. Unlike traditional savings accounts, they offer much higher interest rates, helping your money grow while remaining easily accessible. During economic downturns, having instant access to cash without risking principal loss is crucial, making high-yield savings accounts a dependable first choice. 2. Certificates of deposit, CDs. Certificates of deposit are another low-risk, FDIC-insured option for safeguarding your money. CDs typically offer higher interest rates than savings accounts in exchange for locking in your funds for a set period, from a few months to several years. If you anticipate economic instability but don't need immediate access to your funds, CDs can be an excellent way to preserve capital while earning guaranteed returns. Laddering CDs can also provide a strategic way to maintain liquidity while capturing better yields. 3. U.S. Treasury securities. U.S. Treasury securities, including Treasury bills, T-bills, Treasury notes, T-notes, and Treasury bonds, T-bonds, are considered some of the safest investments worldwide. They are backed by the full faith and credit of the U.S. government, making default virtually impossible. During times of market volatility, investors often flock to treasuries as a safe harbor. Short-term T-bills are particularly attractive for those seeking low-risk, short-duration investments that can be quickly liquidated if necessary. 4. Money market funds. Money market funds are mutual funds that invest in short-term, high-quality debt securities like U.S. Treasury bills and commercial paper. Although not insured by the FDIC, money market funds are heavily regulated and historically stable. They offer better yields than traditional savings accounts and maintain a focus on capital preservation. During economic downturns, choosing a high-quality, government-backed money market fund can offer both safety and liquidity for your cash. 5. Gold and precious metals. Gold has been a traditional safe haven asset for centuries, especially during times of inflation, currency devaluation, and political unrest. While the price of gold can fluctuate in the short term, it tends to hold its value over the long run and serves as a hedge against systemic risks. Silver, platinum, and palladium are other options, though they are generally more volatile than gold. Physical ownership of precious metals or investments through ETFs can diversify your portfolio and enhance financial security during turbulence. 6. Short-term bond funds. Short-term bond funds invest in debt securities with short maturities, typically less than 2 years. These funds tend to be less sensitive to interest rate changes than longer-duration bonds, making them less volatile. While corporate bond funds carry some risk, high-quality government or municipal short-term bond funds offer a stable way to earn modest returns while maintaining flexibility. Carefully selecting low-risk bond funds can protect your investment from significant market swings. 7. Dividend-paying stocks from stable companies. While stocks are generally riskier than fixed-income assets, certain dividend-paying stocks from financially stable companies, often called blue-chip stocks, can act as a safe harbor. Companies in sectors like utilities, healthcare, and consumer staples often perform better during economic downturns because they provide essential services. Dividends offer a steady income stream even if stock prices dip, providing a cushion against market volatility. 8. Real estate, especially rental properties. Physical real estate can be a robust hedge against inflation and market instability. Unlike stocks, real estate often holds intrinsic value, and rental income can provide a steady cash flow. In uncertain times, properties in high-demand areas tend to retain their value better than speculative real estate investments. Moreover, real estate investment trusts, REITs, focused on essential sectors like healthcare and industrial properties can also offer exposure with higher liquidity. 9. Stablecoins and select cryptocurrency assets. While cryptocurrencies are typically volatile, select stablecoins pegged to the US dollar, such as USDC or USDT, can offer a digital safe haven for cash during uncertain times. Stablecoins maintain a one-to-one value with the dollar, providing stability while enabling fast transfers and easy access to decentralized finance (DeFi) opportunities. However, it's crucial to choose highly regulated, transparent stablecoins to minimize risk, as not all crypto assets are created equal. 10. Treasury Inflation-Protected Securities, TIPS. Treasury Inflation-Protected Securities, TIPS, are government bonds specifically designed to protect against inflation. The principal value of TIPS rises with inflation and falls with deflation, based on changes in the Consumer Price Index, CPI. During periods of economic uncertainty where inflation is a major concern, TIPS provide a reliable way to maintain the real value of your investment, offering both security and inflation hedging in a single package. When economic storms threaten, it's crucial to prioritize the safety and preservation of your capital. By carefully selecting a mix of traditional safe havens like high-yield savings accounts, U.S. Treasuries, and gold, and exploring slightly more aggressive but still stable options like dividend-paying stocks and rental real estate, you can weather the financial turbulence ahead. Diversification remains the golden rule. Spreading your assets across multiple safe havens will reduce the risk of catastrophic loss and give you greater financial peace of mind. Stay proactive, stay informed, and most importantly, stay protected.